Greetings, and thank you for joining today's program, Investing Through Market Cycles. My name is Kristen Kolish. I'm a financial advisor and a partner with the Mahoney Group of Raymond James. And I'm especially excited to be speaking with you today, not just about any market cycle, but this market cycle. We've entered 2026 following 3 consecutive years of double-digit growth in the markets, an environment largely driven by the technology sector and headlines focused on its transformative impact. At the same time, this is a market working to digest the long-term implications of innovations that are relatively new to the mainstream. Today, we'll begin by recapping recent market performance and key trends as we move through 2026. Then we'll take a step back and look at more than 100 years of market history to identify enduring market truisms. And here's a spoiler alert: disruption and innovation are not the exception, they're the norm. Society and markets have navigated these shifts many times before, and ultimately they've driven progress, but perhaps not in a straight line. Finally, I'll walk through our go-to investor playbook for navigating periods of uncertainty with discipline and perspective. So let's dive in. You can't control the volatility of the markets. You can control the volatility of your actions. According to a recent Stanford study, only 39% of Americans say that artificial intelligence, or AI, offers more benefits than drawbacks. That is the least optimistic of any country surveyed. While our portfolios have enjoyed AI-related momentum, we're evaluating the evolving use case and impact. Let's remind ourselves that while there are many things we don't get to control, both within the markets and outside, we do get to control the volatility of our actions. Making smart decisions as an investor sometimes means not reacting, but we only know the right decision if we bring it back to what it means for you and your family's personal financial situation. And those are the dots that we're looking to connect today. 2025 was a remarkable year for investors. As a matter of fact, with the exception of one asset class, real estate, and that's real estate investment trusts, almost every asset class posted a positive return. That's unusual. What also is unusual is the fact that we are coming off of a period where 6 of the last 7 years posted 15+% returns. That's an unprecedented stretch. But let's think back to where we were this time last year, the first quarter of 2025. Tariff tantrum, does that phrase ring a bell? The concern was that the pending tariffs and the movement out of the executive branch was going to lead to the end of globalization and really a destruction for economic forces. And despite the market declining nearly 20% during that first quarter of last year, we actually ended the year up 18% with pretty significant economic growth. So I think that this is a reminder that, the headlines may not necessarily be your next go-to decision. We don't want to react too quickly. And as I think about headlines, some of the surprises of last year, particularly given the global economic environment, is that international stocks outperformed domestic stocks. This was the first time that's happened for decades. Developed international equities posted returns of over 30%. And about a third of that return was actually driven by the devaluation of the US dollar. So they had strong local currency returns of about 20%. But then we, as US investors, received a bonus return based on currency. So the markets, as of the end of last year, were very strong. Economists are looking towards 2026, and we'll dive into this in a few moments, thinking that the earnings season, which is ultimately the lifeblood of the market, is going to continue to be strong. However, here we are less than 30 days into the new year. The S&P 500 index is up just over 1%. So the top line is insinuating progress, but the devil's in the detail here. What we're seeing is a reversal of the strength that led us over the last few years. And as a matter of fact, if we look at the sectors driving performance, consumer staples has actually been up 12%. That's almost as much as it returned in the prior 4 years. Contrast that with software companies that have seen a double-digit decline year to date. The market's trying to discern what AI may do to growth prospects for those specifically software as a service companies if AI is allowing these technologies to go direct to the company. You may not need to use that software middle person. However, that's today's snapshot. This is going to evolve over time. What I like about this message is that the companies that the tried and true companies that maybe some would say, quote unquote, are boring, they're leading the charge so far. You might have seen a headline that Walmart became the 12th company to reach 1 trillion in market cap. They're joining the list of predominantly tech names. We also saw that the Dow Jones Industrial Index, it's an index that is more diversified than the S&P from a sector perspective. It is not dominated by tech. It actually reached a record high of $50,000 this week. Let's think through what are the favorable factors of where we are in the market and what are the risk factors. As we meet with you during our ongoing portfolio reviews, these are constant. They're evolving, but there's always factors that might be favorable, and we're balancing that with risk factors. The good news is that the economy is strong. Corporate fundamentals, earnings growth has been good. Sales have been good. Margins are strong. Spending on CapEx and AI, that has led the markets going into 2026. But an interesting detail here is that the earnings season in the first quarter of 2026 has seen the markets react differently to different companies. You've seen companies like Amazon that announced significant CapEx spend and the markets pulled back. You've seen a company like NVIDIA had a higher CapEx spend and the market rewarded them. So ultimately, spending for the sake of spending is not necessarily leading towards growth. We're thinking forward looking. And this is a great reminder. Ultimately, the market is a forward looking mechanism. It wants to discount future cash flows. And it's not necessarily the earnings that existed this quarter that matter, but we're weighing what does the market believe is going to happen in the future. So earnings surprises are something that could impact positive or negatively a company's rate of return. We'll evolve. We're continuing to see evolution with the Federal Reserve. This time last year, I think the anticipation was for more frequent rate cuts. We saw a few last year. We're expecting a couple this year as well. A large factor that economists are pointing to is the impact of last year's tax cuts. And in fact, it's projected that Americans are going to receive tax refunds that are 20% higher than they've received in the past. And the hope, if you're rooting for GDP growth, is that those refunds are going to get spent. So we'll have to wait and see how that's going. And I think another real favorable factor, and I'm going to show this to you more in a moment, is the broadening of the equity market returns. It's not just, if you've heard the phrase, we're going to talk about it today, those magnificent 7 tech names that are driving market returns. We're starting to see a broadening out, and that's much healthier. But there's risk factors for sure. I mean, the one that could turn on a dime is geopolitical conflicts. Those are truisms. The details may be different in 2026 than they were 10, 15, 50 years ago, but that's always a factor that's outside of our control. I mentioned before that valuations are strong, perhaps even expensive. Investors are feeling pretty good, and not surprisingly, if you're in the market, your net worth over the last few years has grown to a point where you might feel comfortable. And that's not a bad thing, but it's something to go in with eyes wide open. Markets don't just go up, they can go down as well. So half the battle is managing expectations. We do hear a lot of companies in this wait and see mode. We are in a moment of transformative change. And sometimes it's prudent to take a step back instead of investing in something that might change in the short term. So we are seeing that as well. We'll see where earnings play out, and there's a lot of different use cases for the AI and tech that we're discussing. Margins are strong now, but to the extent that revenues go down or expenses go up, that is a tricky situation. And of course, inflation. If the Fed cuts rates too quickly, inflation can be a concern in the future. And let's not forget that 2026 is a midterm election year. So there's the potential for some political noise there as well. So here we are. Let's take a look back over the last 5 years. You've heard us talk about the Magnificent Seven as the names, the tech names that have driven growth. I've heard people compare this tech rally with the tech boom of the early 2000s. And I want to make one observation. While the earning momentum, the stock return momentum might be similar, the earnings were not. In fact, if you go back 25 years, the tech names that drove markets weren't even earning a profit. So the good news here is that the companies that we're investing in are making money. You can see that on the right-hand side of the page here. The green bars show the seven largest technology companies, their earnings growth. 60%. 2022, as we remember, was a tough year for both stock and bond markets. It was down 14, but then rallied back very quickly, 31%, 40%, and then 21% earnings return last year, and that anticipated in the future. We're starting to see more growth from the other 493 names in the market, and you can see that the return share of the S&P 500 dominated by the Magnificent Seven. 2023, 76% of the return we got from the index came from those seven names. Last year, it was only 23% of the return. Let's dive a little deeper on this topic, artificial intelligence and implementation. Now, consumer adoption has surged. You may be a user of Copilot or ChatGPT. And ChatGPT is, in fact, one of the fastest growing apps ever with over 800 million users. And the adoption is tracking twice as fast as the internet. But the enterprise adoption is really most important for the markets. And as I've alluded to, businesses are the ones that some of them are taking a wait and see approach. Surveys show over 40% of businesses are already paying for AI services. However, they're doing it in a measured capacity. Now, some of the challenges to adoption that remain include regulation, legacy systems, and tighter R&D and CapEx budgets. But this shift from experimentation to deployment is underway. What we can see in the graph here is businesses using AI in any business function. So when we look across all sectors, it's about 17%. The trend is expanding, and it's also moving beyond just the information technology sector. This happens to be one of my favorite slides in our market overview deck for the fourth quarter of 2025. And it is because it's a great reminder that what we know as fact today may not be fact in the future. Markets evolve over time, and that could suggest that today's winners will likely rotate at some point in the future. So there's two observations I'm going to make here. If we start on the right-hand side of the page, this shows us the top 10 holdings of the S&P 500 in 2025, and it makes up nearly 40% of the index. Now, that's nearly twice as much as the top 10 has comprised the index in the prior decades, going back to the 1980s. So this is important because when we build portfolios, we're thinking about diversification. And we really have to lean into investments outside of the S&P 500 to complement an index that has passively gotten more concentrated over time because of the strength of the largest sector, which is technology. The other observation is that of the 10 top names here, only one of them were in the top 10 in 2015. And if we look at Microsoft and Apple, Berkshire, and JP Morgan, Microsoft is the only name that also was in the top 10 20 years ago. And if we zoom out and we go back to the 1980s, we notice the sectors that dominated were the autos, were the energy sectors. And none of the names that dominated in 1985 in the top 10 are in the top 10 today. So what does this mean for investors? I don't think it's a long shot to fast forward, 10, 20 years out and expect to see new names here. So that's why it's important to be thinking about a measured and diversified approach to your investing. Now, we can be diversified within our stocks, but this is a great time to look at our bonds and why do we own bonds? We own bonds for two reasons. One is for income, it's for cash flow. And over time, the best predictor of your return in the bond market is going to be the current yield. And as of today, the current yield is between 4 and 4.5%. What we've noticed over time, and this is the evolving interest rate environment, if you took out a mortgage in the 1970s or 1980s, you were likely paying well over 10%. In today's market environment, interest rates are lower, both for borrowers and for savers. But if our time horizon is the comparison of 2020 to today, conservative investors, savers, are finally getting a rate of return on your bonds and on your cash because interest rates at that point were so low. And that is starting to create an attractive alternative to stock. There was a phrase 5 years ago, an acronym, TINA, TINA. There is no alternative, meaning you had to invest in stocks because you were getting nothing from cash and bonds. And we've seen a change here. The other thing that I'll note as it relates to bonds, that interest rates and bond prices move in opposite directions. If interest rates go down, bond prices go up, and vice versa. If interest rates go up, bond prices go down. But because we finally have some coupon, the risk of interest rates going up and of us receiving a negative total return on bonds is starting to dissipate. The second reason, and maybe I'd even argue the more important reason to own stock, bonds with your stock, is that diversification. So what we show here is when the S&P 500 has had difficult periods of time, the Bloomberg U.S. Treasury Index has supported and provided some diversified return to ballast that portfolio. What we're going to see in a moment is that the extent of a potential decline is hugely important to what you need to experience to rebound and get back to par. This is a little bit of the math of investing. Ultimately, we are looking to build portfolios that meet your goals. And meeting your goals might mean, and likely means, drawing on the portfolio, whether that is each month, whether that's periodically. So we don't want to be in a position where we have to sell stocks into weakness, which is why when we look at what a balanced portfolio has done over the last 15 years, that gives us some comfort. That's the line in the middle of the page. And you can see here that the average annual return for this balanced portfolio was 7.3%. Now, over the next 15 years, is it going to be that high? It may not be. But one thing to note is that it was never the worst and it was never the best investment. And ultimately, the amount that you have in stocks, or I'd say return-seeking assets versus your more conservative investments, maybe your safe assets, is going to be driven by your time horizon. And I'm leading you into a future section, and your personal comfort level with risk. History tells us that what exists today may not exist tomorrow. And I don't know about you, but I'm in New York, and we are in the midst of a polar vortex. I'm not loving the weather. In many ways, the market is like the weather. If you don't like the current conditions, all you have to do is wait a while. So I am waiting for springtime and hoping that it comes soon as it relates to the weather. Now, the weather and the markets have been favorable, but this is a good reminder for the future. Lessons over 100 years of investing, and I'm going to give you some examples for each of these 5 mantras. The first is that fundamentals matter. The second is that time is an investor's greatest asset. The third is that diversification does work. The fourth is that we need to balance opportunity with risk. And then the fifth, as I alluded to earlier, is that disruption is constant. Over time, stock returns are not going to be positive unless there's earnings. Now, it may not move in parallel with one another, but what we know as we look over the last 30 years is that over 3/4 of the stock returns that we've experienced has been driven by earnings. The other thing we know is that positive earners have significantly outperformed those companies that have negative earnings. So I've heard people talk about the stock market as a gamble. It feels like you're going to Las Vegas. You don't know if it's going to go up or down. And in any given day, maybe. But ultimately, there are fundamentals that matter, and it's the health of the company that you're investing in. Ultimately, think about stocks as ownership. You are a part owner in a company. You want strong free cash flow. You want to see sales growth. You want to see earnings growth, and you want to see low debt. Those, quite frankly, are 4 things that you want to see in your personal net worth situation as well. When we look over time, stocks have averaged just over 10%. I think it's important, however, to remind ourselves that 1 in 4 calendar years has been negative. So if you think about 75% of the time, your calendar year is positive, 25% it is negative. And I mentioned before, in 6 of the last 7 years, we've actually seen double-digit return in the S&P 500 index. So if we were to see, I don't know if it's going to be 2026, 2027, we would expect at some point we're going to see a negative rate of return in the market. Another observation here is that as you start to introduce additional asset classes, the likelihood of a negative year does in fact go down. So time is an investor's greatest asset. We like to say that it's time in the market, not timing the market that matters. You've heard us talk about this in the past, our current clients, but it's worth repeating. Because in an environment where we're saying that valuations are expensive, you may be thinking, well, maybe I should just get out of stock. Well, the problem with that approach is that you need to get 2 decisions right: when to get out of the stock market and when to get back in, which is why we are not proponents of timing the market. The reason why missing 10 of the best days has such a negative impact on your success is because the best days tend to happen in and around the worst days. So it's nearly impossible, we don't have a crystal ball, to identify when those best days will be. This is why when we think about building portfolios, diversification is something that matters. Rebalancing, we're going to talk about in a minute. That is our equivalent of reacting to the markets. I love this slide. It demonstrates calendar year returns for a 60/40 portfolio. Back in 2022, when bonds had their worst year in decades, there were multiple headlines that talked about how maybe the 60/40 portfolio is dead. And what that means is a balanced portfolio. And at that time, it seemed like the reality. But again, when we zoom out, yeah, there's years where that doesn't work. You can actually see 2022 happens to be one of 3 years where your rate of return for a 60/40 portfolio was between -20% and 0%. But the lion's share of the time, it's been positive. In an environment where you hear a lot of investors talking to their individual stocks and what's driving performance. I always get nervous for especially our young investors who might have had some early success investing in individual stocks. They don't appreciate how significant luck might happen when it comes to the amount of time and when you get into the market. This is a great lesson in math, but it's something that is just so important to stick with you. The mantra of doing no harm, managing losses matter. And why is that the case? Well, big losses are hard to recover from. In fact, if you had a 50% decline in a stock, you would need a 100% gain to recover from that loss. So that's pretty staggering and perhaps overwhelming. The good news is that if you were able to limit your loss, the gain you would need to recover is a lot more manageable. A 25% loss, you only need a 33% gain. And if I'm looking at your portfolio overall, a balanced portfolio, you see a 10% loss, you actually only need an 11% gain to overcome that loss. So math matters, managing losses matter, and this is why we belabor the point of diversification. And how do we manage that diversification? We manage it through our rebalancing process. The graph here shows us a portfolio that was a 60-40 in 2019, in the absence of rebalancing, would have grown to 72% stock in 2025. Now, rebalancing can occur based on market movement, but don't forget, we're living off of our portfolios. We also rebalance based on cash needs. As you need to take liquidity from the portfolio, or as an investor is adding liquidity to the portfolio, we're going to draw from those sectors. We're going to take from the sectors that are overweight to our target, and we're going to add to the sectors that are underweight to our target. The fourth of the five mantras is that we want to balance risk with opportunity. And I can't emphasize enough the importance of your spending rate. You know, we spend a lot of time doing sophisticated planning and modeling, and it leads to some great conversation about the trade-offs, right? You know, what happens if I spend more? What does that do to my legacy? Or if I take more risk or less risk, what does that mean to my retirement age? But I do believe that there is something to kind of these rules of thumb, the back of the envelope math. And ultimately, your spending rate, your withdrawal rate is going to be driven by, one, the way you're investing, but the size of your portfolio. And over time, we really don't want to be spending much more than really no more than 5% of the portfolio. I'd guide you more towards 4%. So if you think about your spending as the liability your portfolio needs to meet, and we think about the potential return as the growth mechanism, as long as we're able to thoughtfully manage your cash flows during periods of volatility, then we're just relying upon your portfolio over a market cycle to outperform the spending rate. Think about that. If you're spending 4% of your portfolio to maintain, if you're looking to maintain the purchasing power, you need to outperform that. But where investors get tripped up is not bucketing and not thinking about their short-term cash needs and when to get it. Lastly, I mentioned in my opening remarks disruption and innovation and how they are a constant. It is understandable to think about this as a relatively new phenomenon, right? I mean, artificial intelligence was not dominating the mainstream headlines a few years ago. I think this is a great reminder that every generation has its disruptive technologies. What we see here is that the amount of time it took for 25% of the US population to be using this new technology in earnest. So it took 48 years for more than 20% of the US population to be using electricity. Fast forward, it took less than 5 years for social media to reach 25% of the population. Artificial intelligence, even more, 2 years. So the transformative, disruptive nature of innovation is not new. And what we know is that the incumbents that exist in the beginning will be challenged. New companies and industries are going to come on board. And there may be a paradigm shift within each of these innovations. You know, you think about RCA radio or Magnavox television set. They were leaders at the outset, and it transformed over time. We mention this because big tech companies earlier, while they might benefit from AI, it's not just the companies providing the microchips that matter. It's to think about how are companies going to use this to become more efficient, ultimately maybe driving the cost down of their services or expanding what we can do in a shorter period of time. What does this mean to you? We want to beware the hype. Take advantage of opportunities from disruption means that we're not making bets, that we are making sound investments based on what is occurring in your personal situation. So that leads us to our last section, the investor playbook. Market fluctuations are your friend, not your enemy. Profit from the folly rather than participate in it. Another great Warren Buffett quote. Ultimately, we don't have to react to what's going on in the market. And in many ways, that gives individual investors a huge advantage over institutions. You get to drive your timing. So I'm asking you, what are the things that you are investing for? What is the time horizon allocated to your investment objectives, and how much is that going to cost? And this is informed by your life stage. It is informed and it's going to evolve over time, whether it's retirement or cash reserves, college savings, managing debt. Maybe you're looking to grow your legacy for a future generation. We want to let your why drive your investing approach to goals. And for many listening, this is a reminder. I personally think that this approach kind of disarms and makes a little less overwhelming the decision about how to invest. Because if we know that you're going to be spending your portfolio or you're going to need cash in the next 12 to 24 months, okay, we're not going to stick all of that in the stock market. If we know that you're investing for a goal that's decades out, okay, you have the wherewithal to put most of that into something that's going to grow. And then when we think about your goals in the intermediate term, that's where we're looking for some balance. Ultimately, your life stage does inform how you're prioritizing your financial resources and your investing strategy. And quite frankly, how the Mahoney Group as your financial advisory team can support you. In so many ways, we talk about much more than just your portfolio returns, because portfolio returns without a vision of what you're using and investing the portfolio for is really, it's not impactful. These conversations matter. We encourage clients to think about managing your finances like a business. You know, I talked about the math of investing and the math of losses. First, do no harm, then look for opportunities. We talk about building a fortress balance sheet. The attributes that we look for in investing in stock are similar to the attributes that you want to execute in your personal life. Have a financial plan, stay disciplined, looking to temper emotions. Know your cash flow. Know your cash flow off the portfolio. That's something we pay very close attention to. And know your cash flow as a household. Because if you have a handle on your cash flow, and if things get a little dicey, wow, that could actually lead some really interesting opportunities. You've heard us talk about this before, the emotional roller coaster of investing, where when it feels really good to be an investor, that might be a more risky time because prices are high. And when it feels so terrifying to be an investor, that could be really when there's a great opportunity to make money. Where we are today, I think we're closer to, we're coming off of 3 really strong years. So we're not where we are in the defeated mark. I don't want to necessarily call it euphoric, but we're definitely on that uptrend. So how do we react? The diversification piece is important. If you are still accumulating, continuing those contributions, if you come into cash, we're thinking about investing it thoughtfully over a period of time, maybe not in one fell swoop, sticking to your plan and letting the rebalancing process work for you as you need cash from the portfolio. Ultimately, it's not what happens to you, but how you handle it that matters. As your advisors at the Mahoney Group, we are so appreciative of the trust that you place in us for our financial advice and guidance. In a world where we're seeing the markets driven by technology, which seems to be kind of depersonalizing so many aspects of our lives, we truly value the relationships that we have with you all. And we believe in the importance and the necessity of personal conversations to make sure that your investing approach works for you and your family. Please reach out with any questions. At the end of the day, we are here for you, and we want you to have confidence that the plan that we have in place is going to lead you to success regardless of where the markets take us. So wishing you all the best for health and happiness, and looking forward to continued conversations in 2026. Thank you.